Hi, good morning, everyone. Thanks for giving us the time and opportunity for this webinar. Let me give you introduction. My name is Ankush Sharma. I take care of the alternate sales with Purnartha as a vice president and regional head with this company for last 9.5 years. Overall banking experience of 15.5 years, basically. So uh, again, today's session would be more of, so we have already got few questions which have been asked by the participants. The flow of this presentation or the webinar would be, I have my colleague, Mr. Koustubh Gokhale. He's from investment counsel team. So we have a team who basically bridge up the gap between the research analyst as well as clients or channel partners. He will represent that. He's head of IC basically. He will run you through the entire propositions which we are currently offering to our customers in this market, basically. So, just to begin, we'll just give you brief introduction of Purnartha. The name itself says it's basically a Sanskrit word which means Sampurna wealth, basically, complete wealth. So, just to give you begin, we started in 2011, basically. We got the license from SEBI of advisory um, in 2013 July. So we do only one thing, that is equity research, and our research is also backed by only fundamentals. So we basically study the fundamentals, study the balance sheets and profit and loss statements, and accordingly advise. So we don't come from the technical school of thoughts, basically. It's more of fundamentals, more on the data crunching, basically. And this is what we do. This is the only thing which we do. So we are basically a SEBI registered investment advisory firm, and as well as a uh, portfolio management services. So, uh, so the journey started in 2011, basically. So when my promoter came from US, he himself coming from very pioneer family of Pune. He was having his own money, family relative. He started with this unique proposition, with the unique philosophy, basically. So 2013, we got the license, as I said, of advisory. We were the first who got the license in Pune. So this is how it started, the overall journey, basically. So we started retail operation July 2013. 2016, we got various institutional tie-ups like IFL, Sharekhan, and Citibank, basically. Uh, 2020 was one of the period where, with the regulatory norms, we also added PMS license. So we got the license of PMS in July 2020. 2021, we added one more offering, that was Sampurna. Again, in PMS, we crossed almost 1,000 crores in 2020. We were the fastest growing company in that point of time. And we also added few strategies under PMS. So why I'm telling you this background is, basically we do only one thing. As I said, it was more of equity research, which is restricted to only fundamental. And we basically create a portfolios for the customers according to their need and the risk appetite, basically. Uh, we don't do so. You'll not find Purnartha, just to give you background. We not find Purnartha putting across on terms of, target driven, or the overall thought process is identify good companies, the companies where we are seeing a continuous in terms of balance sheet growth in the various parameters to evaluate and stick into those companies, basically. So this is a brief background of Purnartha. So we are live at 14 locations in India, basically. We are close to almost 2,500 crores under AUM under PMS, that is portfolio management services, and 6,000 crores under advisory firm, basically. In 2021, so we are the fastest growing company with managing almost 15,000 crores AUM, basically, that point of time. So today's session would be more of one of our strategy under advisory with the name of Emerging India. Now I would like to hand over to my fellow colleague, Mr. Koustubh Gokhale from Investment Consulting. Over to you, Koustubh.
Thank you. I hope I'm audible. Yeah, thanks. Thank you, Ankush, for that introduction. And from that perspective, what I'll also like to sort of introduce is that, so as an investment counselor, the role that I play typically is to try to give a sense of how we look at investments, and also try to guide clients in terms of how they could look at their investments. That's That's really where I get placed. Now, what we are speaking today is more about a product which is based on an investment advisory, and it's called Emerging India as a product. Now, what this is really focusing on, so the way I would like to take the workflow in terms of explanation is what are we really trying to focus on would be the first part and give a sense of why we are doing that. And then the second part would be how we are trying to sort of achieve getting those sort of earnings growth, for our clients, and eventually a few examples to give a sense of how it plays out. That's really the flow that I would like to take forward. The other thing is that within this, there are a few questions that have been asked, and we'll try to cover a few of them during the course of this flow. And whatever gets, what remains, we'll take up at the end. So that's really the way I'd like to take this forward. So what is really Emerging India as an advisory trying to sort of focus on is at a very broad level is about the fact that at this point in time, if you look at the countries that are actually growing, especially in as a rate of growth, if you were to look at it, you'll see that India does happen to be, even today, happens to be one of the highest growth, what you can see, especially in bigger economies. So, given that we are in the right sort of place to leverage that growth, and this growth in the economy generally tends to help in certain spaces where the sectors are going to do better than the other, and that is where you typically add value as a investment advisor. Now, within that, what we are really trying to look at a very broad level is this is something that BCG articulated, that's Boston Consulting Group, that articulated that what kind of growth we could see in India vis-a-vis, of course, this is more on the longer term, but it gives you a sense of where the growth would typically come from. And from that perspective, this slide is informative that if you really want that sort of growth in India, and if that is what we are targeting, what would you be typically looking for in terms of growth rates, as they have mentioned over here in the key enablers? That really what you need for this growth to come through is essentially you need the credit growth to play out. That is one part. The second part is really manufacturing, because if you would recall, the last 20 years has been more about service industries and being focused more on the service part of play. But going forward, if we really want it to continue, manufacturing is something that becomes an important theme for us. So obviously, I think one of the questions that was also there was that, so where would we be focusing on? So that would definitely be the way forward if we intend to grow at a higher rate. The second part, where you would be aware that at this point in time, this is where the flux is going on in terms of AI. But definitely, this is the other pillar on which that growth would come. And in a sense, this is also linked to skills and talent unlock. Of course, manufacturing also requires its own skills. So that would be the third enabler that you want. And given the fact that, especially if we speak of AI, if we speak of manufacturing, you need energy to actually be able to generate all this. So from that perspective, that energy transition is also something that would be a focus area at a very broad level. Of course, this is in terms of enablers. So obviously, the next step over here would be that are we actually working on that way as far as the country goes? So if you just give me a moment. Yeah. So if you look at the Make in India initiative, now this, when you speak of Make in India, it's a very broad, canvas that is there. But within that, what are the sectors where there will be a focus again, both on the manufacturing and service side? Is there is a very clear focus on the defense industry, something that you might be aware of. The fact that automotives and auto ancillaries are a focus area, pharmaceuticals and medical devices, these are certain sectors, chemicals, which has not been doing very well over a period of time, specifically after the Russia-Ukraine war has started coming into its own. So textiles has its problems. So there are ways in which the government is trying to focus on helping textile. capital goods, biotechnology, electronics. You might be aware of the fact that there's a significant growth in terms of electronics that is being produced or at least assembled within the country. Food processing. So some of these sectors are basically the areas which give us a lead as to where things could go right. So obviously, given the times and the changes that are happening overall, there will be some laggards, there will be some winners. And that's where you basically want to bring the research part of it into play. Similarly, on the on the service side also, you would see that, for example, tourism and hospitality has been doing quite well. Construction, again, on the service side, given that there's a focus on infrastructure, these would also come through. And finally, at the end of the day, all of this requires money. So the credit growth that comes through in financial services also becomes important. From that perspective, you can see that there are these sectors where you would typically see areas where you might actually end up making money. So this is the other in that flow why you think that playing within India would make sense, but then it has to be specific to sectors depending on where the focus is. Now, from that perspective, if we go one level lower, because this is Make in India is an initiative, which is a very broad-based initiative, but how does it really play out? So one of the ways that the government is doing this is through initiatives which are more specific. And this is where you start looking at. So this is like the way you should look at it is at a macro level, we know India is growing, but within that, where is really the focus happening, at least as far as the intent? Then the next level would be that within that, where are the initiatives actually taking place? So where is the action basically been generated? And from that perspective, you'll see that these initiatives are the initiatives that one has to really focus on. And then, of course, you again deep dive within that. So, for example, if we were to look at production linked initiatives, for example, so from that perspective, if you look at the PLI scheme, this helps you drill down one level lower, that within those sectors, where is really that push there in terms of the government giving incentives to produce more. And over here, it's not only production, it is also in terms of sales actually happening. So it is not just about inventories being created. In fact, that's the way it has been. The PLI scheme has been created so that it is linked to actual outcomes. And over here, this gives you a further one level draw down in terms of where the focus should be in terms of the sectors. So some of these sectors, such as the EMS play, has worked particularly well, and investments continue in this space. Automotive, given, of course, there are other reasons. For example, the GST rate cut that happened in September, that also helped to drive auto sector. So there is the PLI scheme, and then there are other overlays by which some of these sectors have pulled ahead, and some of these sectors, for example, textiles, have had problems because some of their external, so basically where you are supplying, for example, the US, where the tariffs increased. So because of that tariff increase, Bangladesh, of course, this is a bit in the hindsight, but to give context that yes, this does give you a broad canvas in terms of where to pick from, but then eventually you have to go one level deeper to understand where are the structural challenges coming. For example, in textile and apparel, that is something that has been a problem for the industry. But for other sectors, it has actually benefited. For example, food processing. Now, in food processing, there are certain spaces where there is a problem that even if there are tariffs, you can't really, replicate the same sort of supply chain overnight or even in a year in other geographies, because much like crops, there are certain climates where things work better. So there is that natural mode that you get. So once you understand that, you would play selectively. Of course, not in every space you will get that sort of a mode, but then that is where the analysis or the research comes in. But at a broad level, where would my focus typically be? It would be in these areas where there is a push, because that is the sort of tailwind that is required to take things forward. Now, from that perspective, again, one of the other initiatives that are there. Now, if you link this, you'll see that so these are all factories and manufacturing plants or products that you're making. Now, finally, once you make the product, it needs to be delivered. So from that perspective, the Gati Shakti Yojana makes a lot of sense because it's a natural linkage to that infrastructure that you've created on the manufacturing side. So again, these focus areas, be it roads, be it ports, be it railways, and there's a lot of investment that is happening, and typically you'll have some sectors that will open up because of that. So for example, when you speak about roads, you will have cement come through, right? There will be steel that will be required over bridges, infrastructure, construction. So there, each of these would have a further linkage. Railways, again, you've got very specific companies that are playing this out. So for example, there are companies within the wagon space. Again, when you are speaking about metros, again, you've got bogies that you have to focus on. So again, all of this helps you to sort of filter into where these, what does this really mean? So when one is investing into roads, what is the sector which is going to benefit? And then you want to deep dive into the specific companies to realize that or understand which of these companies have the right to win. And that's where you come down to the next level. But these are basically my pointers in terms of where I would like to go. And again, what you'll see is that there's a very clear linkage in terms of what they are trying to do and how they are trying to deliver it, right? So that is, these initiatives also give me insights, and that's where I would like to play in terms of getting value for my investors. And finally, the UPI growth that you've seen. So one aspect that also is very important is the fact that you need your rural population and also on the educated uneducated divide to be bridged, especially to bring the informal economy into the formal economy. Now it works on two levels. One is that there's more financial inclusion at a lower level that helps in basically disbursement of benefits that the governments tend to provide, and that is one part of it. But the second more important part of it is that when the government is trying to build on these infrastructure schemes, and what they are also saying is that we are going to support you. Now if you've got to support, you should also have the money. The government should have that sort of revenue to be able to support. So from that perspective, it becomes important. And I think one of the most important aspects that this opens up for us is the better credit access, both at a retail level, because now people who, for example, did not have access to accounts, they were forced to take loans, but this was all informal and at very high interest rates. But what this has allowed is better credit access. Now this helps both on the consumption front, but also on the fact that MSMEs, which might have had challenges earlier, or small scale entrepreneurs, they also gain access. And that helps, especially in a time like this, when, for example, in West Asia, there are challenges. A lot of MSMEs are actually under pressure. And because they are under pressure, when the government wants to help, now because they are within that space in terms of there is that access that they have availed of within the formal financial system, it's also easier for them to provide any sort of respite that they plan to have. So all of this essentially also works in our favor in terms of picking up what we would like to invest into, right? So now, given all these inputs, what you eventually do is you understand that what is the broad framework where I would like to play or where I would like to get my investments into. Now, the next level is where we start coming into the picture, is that you understand the broader narrative and you understand where things could probably go down in terms of where you could actually take benefits. But then that's where the next level comes in, that here now, as I mentioned, you understand the sectors, but now the fundamental research tries to help you to demarcate that where is the wheat and the chaff. So what is not very good and what is good to invest into. That's where the fundamental research comes in, and the focus typically tends to be over the medium to longer term. Why? Because some of these plays, because you are investing now, it will take time to scale up. So from that perspective, the medium and longer term plays, if you can stay invested in the right sort of companies, you tend to get the benefit, because you've got to understand they are also starting at a very smaller base. So from that perspective, you need to give them time to grow, which is why we look at a more medium to long term horizon. because it allows us to give that company that space and scope to grow. The second is the fact that if you've seen whatever I spoke till now, since there are so many sectors and we understand that, look, there could be, potential within a variety of sectors, it doesn't make a lot of sense for me to be very specific in terms of the sector that I want to be in. And which is why we take a sector agnostic approach, which means that I'm not very hung up about a particular sector. Now, what that allows me is it allows me flexibility. Since I'm not taking a very myopic view in terms of one sector where I'll be very aggressive and I will not look at the other. So that's where the approach, why it is sector agnostic. And as I very clearly said, why we look at a medium to long term perspective is because that's where both the compounding happens, and practically for the company to grow, it needs to be given that sort of time, which is why we look at it in this fashion. Now, if I was to take it one level deeper in terms of what we try to do, so whenever you have a particular fund or a fund manager, there would be a particular structure that you would want to give to your investments. So this is inherently trying to cover that part of the portfolio construct. And what you'll see is that at a very high level, we start off with the Nifty 500 as the overall universe to pick from. And within that, as I mentioned earlier, you will see asset allocation across diversified sectors. So again, as I mentioned, in all those sectors, there would be certain sectors where the attractiveness is high. So if the attractiveness is high, you would typically want to be more into those sectors, since there is a particular benefit in terms of tailwind that you see in those sectors. But on the other hand, it would not be always applicable across sectors, and hence you need to have that weightage that has to be given to your positions. But we still have diversification that is allowed. Now, from that perspective, what is the number of companies that we typically keep in the portfolio is 12 to 18 securities. So 12 to 18 companies is that we have. What that gives me is opportunity in terms of dabbing into different sectors. So there is that degree of diversification that I can do. And the second thing is that it's a multi-cap portfolio, which means that I also play market caps. So there will be phases where the large caps look more attractive compared to the small caps or the mid caps, and it could be the other way as well. Also, in a risk of environment, I might take the call to be more large cap oriented. So the allocation is one at a sector level. The second level of allocation is also at a market cap level, and hence it's a multi-cap portfolio. In terms of the allocation, you will see that the maximum that we allow ourselves is 10% allocation. Now, there was a question from somebody, within our group, where there was a mention that how is it different from the older advisory. So if you have been exposed to the older advisory, you would be aware that it used to be a very concentrated portfolio of 5 to 6 stocks when we initiated the advisory. So from that perspective, the change is that now it is fairly more diversified. There are reasons beyond for why that has happened, and maybe we'll take it up if that question arises. But that is one differentiation that is definitely there. Now, what we also do is on a risk mitigation front, obviously sector diversification is one thing that plays out. Scuttlebutt analysis is more about trying to figure out on the ground. So, for example, when you speak to managements, they will give you a particular view. But if you want to really understand that, is it really something that is playing out on the ground, it would make sense for you to go and check. So, there's typically a supply chain that every company would have. So, there are various touch points where you can reconfirm that whatever is being mentioned by the management, is it really happening or not? So that is something that happens through scuttlebutt as such. The second part is obviously corporate governance checks, because one of the problems again is that there could be accounting issues, there could be challenges within the management. And if you understand this, some of this can be understood from forensic analysis if you do it. The second thing is also trying to understand within the management and within the company. Again, all of this requires some sort of outreach, that you need to do, which is beyond, what would typically be taken as pure research. So for example, if I'm looking at paints industry and I want to find out is paints doing well, typically you would have to, key suppliers that you would want to understand from, that is the offtake increasing. Also, if you see, there is a container in which paints would be filled in. So there are certain companies which supply to paints companies their containers. So you can also check with them that what is the sort of order book that they have. Has it increased? Has there been a sudden, order that has been asked for in quick time? So you get all those insights, and that helps you to confirm or cut the management's view. Also, they are distributors. So what kind of guidance has been given to them? What kind of push is happening on the distributor side? So there are multiple levels. Again, for example, paints, they supply to automotives as well. So the end user is also, that industry is also a level that you can check and get a view in terms of what is happening. So all of that comes through in risk mitigation, and also it helps ensure that the stock selection is stronger. So it has both benefits that you will get. After that, liquidity is one of the other key challenges that we have faced. Frankly, that is one of the learnings from our own history, where we've realized that, if there is not enough liquidity in the stock. For example, if I advise you and the group that, look, this is the company that I want you to buy. Now, in a particular short period of time, if there's a lot of demand and if there's not enough liquidity, you're in trouble because the impact cost is higher. So that is something that also gets covered while making these recommendations. And finally is rebalancing. So one of the questions that tend to come is that, so how much is the churn? So what you would expect typically would be that over a period of time of about a year, you could see 3 to 4 stocks being churned within the portfolio. Now, here the very clear idea is that you're churning because some of these themes are playing out or you're finding something better. So that's really the way to look at it, which is why the rebalancing happens. But if one was to look at, so what would be the churn rate? That is typically what you should be expecting from this approach that we have. Now, what does this all mean in terms of, in terms of the next level? So this is one level of filtration, right? Where you are looking at a broader construct. But eventually, why would those companies earn the right to be in your portfolio? So these are the key points that we look at. And the way I would like to put it is that it would be more of buckets that we create. So for example, we have a growth style of investing. So there are different styles of investing. So the way we create is we create distinct buckets, and we sort of filter the companies, and then we take them forward. So the first level of creating buckets is that we look at companies which are in the growth style. And what does that really mean is that you're essentially looking for companies that are clocking 20% of growth, ideally from the business growth, that's the top line, and it is also flowing down to the bottom line. What that means is that if the growth is coming, it is sustainable also on the operating profits and on the net profit. So if it is 20% growth on the business growth side, it should also mean earnings growth of 20%. So that is one bucket that we create, and that's how we shortlist. That will be one set of companies. The second set of companies that we'll shortlist, or the second bucket, would be on margins. So if you see some sectors, like if we look at today, you will see that crude prices are going up. Now, crude prices would typically affect certain sectors more than the others, which are more energy dependent. Or, for example, again, paints is an excellent example here, because if it's a crude derivative, so if it is going to be produced out of crude, you are, as a derivative, you are definitely going to face margin pressures. Now, that obviously is a negative at this point in time. But when the cycle turns, some of these companies, I'm just giving an example, but some of these companies would also be reverting to the mean because they've been through bad times, and now the margins are becoming better because the raw material costs are normalizing. Now, what that means is that sometimes there might not be growth of 20% on the business growth or the overall top line growth, but you might get, because of margin expansion, you might get a 18 to 20% bottom line growth. And bottom line growth, when we say bottom line, it's about the earnings, the profits that the company make for themselves. So again, that gives me another way of looking at earnings growth, which is at a 18 to 20% level. Now, just to give you a context as to why this ends up being 18 to 20%, or why am I taking this as a number? Because at a level, if you see, you will see that the overall markets, the earnings growth at a Nifty level or a universe level is typically between 12 to 15%. So what I'm trying to do over here is I'm trying to create an alpha of a minimum 5%, right? And that's the reason why it's a 18 to 20% growth that we are looking at. Because typically what you will also see is that over a period of time, this catch up happens, and that's how you end up generating alpha. So that's the reason why you're seeing that repeatedly 18 to 20% number. The third part is valuation and momentum. Now, some of these companies will have valuations which are attractive. And from that perspective, they can add value for your portfolio. So if the rating is quite low because of a sector not doing well, and if the sector starts doing well, typically the sector itself starts getting a better rating vis-a-vis the previous year. So valuation wise, there's attractiveness. And obviously, when I'm saying that a sector is trying to get better, the earnings also start improving. But it's the valuations that is making that particular call interesting, which is why then you have a third bucket of companies which is focused on valuation and momentum. Now, what we do with these three set of companies or buckets is that we put it to the through the next filter, which is ROE expansion. So ideally, I would want my companies to have a return of on equity of at least 15%. Why? Because that is the base case. As I mentioned, typically the markets gives you 13-14%. So if you're not going to keep that as your base, you're not going to be able to generate alpha. Now, some of these companies, specifically valuation companies or margin expansion companies, might not have a 15% ROE today. And that is why this is about the future. We are investing into the future. So even if it is not aware, it's not available today, am I going to get it in the next year? Because that is where that is also something which will allow me to keep these companies in my portfolio. But then this would be my next filter that I would put. And lastly, we put the same companies through a filter of debt. Because when a sector turns or when there are sectoral problems, typically you will see growth coming under pressure. So very a lot of debt is going to impact their profitability, because interest is a fixed cost item. Irrespective of your business doing well or bad, interest is going to be paid by the company. So from that perspective, there is a particular limit that we've set for our companies, the ones that we would like to invest into, and that is that their debt that they take is not more than 75% of the equity that has been invested into the company. What this allows me is that these companies have been given certain capital allocation, because only equity might not be enough for a company which is growing aggressively. So I'm allowing them that leverage, because you want, there is a cost to capital as well. So how do you manage it? You want to balance it with debt and equity. We understand that, but there is a particular level beyond which it starts becoming uncomfortable, because in a down cycle they will get under extreme pressure, which is why this is the filter that we put. Now, based on these three buckets and these two filters, we end up with a set of companies that we would be interested into, and that's where the further fundamental research and deep dive happens. And that would be how we would eventually reach to our final bucket or final portfolio of 12 to 18 companies that we have in the portfolio. This is just a snapshot of where we are today in terms of the allocation, or rather last month. And you would see that again, if you recall what we spoke of. So first I'll look at the market caps. A few months back, you would see small caps were much higher. But given that there has been this run up, and there are challenges that we are very clearly seeing in West Asia, supply chain challenges, which normally do impact small cap companies more. And from that perspective, because of their diversification, tends to be lower compared to large caps in terms of their supply chains. So that uncertainty is more. So there has been a very conscious decision to bring these numbers down, whereas large caps are on the higher side. Now, within that, if you would see the sectors, you will see that some of those sectors that we saw in the initial slides, those are the sectors that we are investing into. Healthcare, chemicals, one of the turnaround sectors. You've got auto sector, which has been doing well. Now, auto sector could also be represented within the financial sector, because you could always invest into a company or an NBFC which is more loaded on giving auto loans. So these can be played in that fashion as well. But then this does give you a sense of that diversification that I was speaking of earlier. Now, what this eventually does is, so this is in terms of what I've tried to cover is what is the overall picture that we are looking at. And then within that, how are we being selective? Now, how is the process of choosing those companies coming out? And eventually, you want to get into the fundamentals of each of these companies to understand why they have the right to win over the other company, and then invest into the company which gives you a better chance of success. And eventually, what I'd like to do is also give certain examples. One of the key points that I would also like to mention in terms of our approach is that, as you would imagine, when we are looking at all these aspects, and there's a huge universe of companies that we have. So typically, we also take benefit of all the research that is being done by other research houses. So there's something called as the consensus, because there are other analysts also which are evaluating these companies. We also use that as a feedback in terms of, there are always chances that we will not cover all the aspects. So we also take that into account, and I'll tell you how does it help us in making decisions over here. So in this company, which is Polymedicure, which is into medical equipment. So if you recall, now if you sort of link this to what we spoke of earlier, medical instruments and healthcare was one of the key sectors that we spoke of, where Make in India is a push. Now, if you look at this company, now this is where the deep dive starts and where you start adding value, in terms of understanding the business. So you know that healthcare and medical is a focus, PLI scheme is a focus, right? Now, in a particular company like Polymedicure, which makes disposable medical devices, what they are doing is they are creating a global footprint. So typically we speak about Make in India, for India, and for the world, right? So that is where it is covering that aspect. The second thing is the evolution part. What is it? What is the evolution about? They were specifically looking at vascular. So, for example, if you want to get a saline, when you go to the hospital, the product that is being used most probably would be a from Polymedicure, right? But what they've done is that's where they started from. But they've realized that, look, there are multitude of therapies and there are different instruments that they require, and a lot of these are disposable. So it's one-time uses. So the good part about this is it's a consumption item. It's not a one-time play. So once you get into a hospital chain and if they approve you, you also get repeat orders. So that is, and this becomes important when you realize that healthcare hospital chains are growing at a pretty strong clip. So if you can get into the consumption side of it, you are diversifying. And secondly, if they are increasing therapies, then you are going to actually scale on both business. And the most important part over here, if you see the rationale, as I mentioned, one is the growth that is there and specifically related to the PLI scheme. So, there is that basis, and I understand that Make in India is something that has been heard of for quite some time. But how does it actually practically end up being important when you're trying to look at a company? Is this particular company actually benefiting from it? And so, as I mentioned, looking at 20% growth and also linking to the PLI scheme. Now, over here, what you'll see is that we have both plays going on. One is the growth that you're investing into, but also the fact that this company is trying to increase their margins. So, if you recall, I said that there are two different buckets, right? But every once in a while, you'll have companies which are working on both the growth as well as margins. And typically, what it will do is it will make your play in that particular company more strong. So for example, even if the growth stutters for some time, the margins expansion will help you to cover it. So the safety increases. Now, so ideally we would like to have both, but typically we understand that not every space or every play will have these two. Now, as I mentioned, we also look at the some time back, I did speak about the fact that we also look at what the analysts or the consensus or the analyst community is saying. So for this particular company, we invested, and you might be aware that this particular EI or this advisory started in April 2024. So when we got into it, as I mentioned, the thesis was that they are going to get 20%. And what you see over here is you will see that what we also focus on is the rate of change. Now, where does it help to have a view from a consensus perspective? Is that overall, are everybody as analysts expecting the rate of growth to keep continuing? Because one is growth of 20%. But what becomes much more attractive is that if that rate of growth is also increasing. So from a 19%, if it is going up 23, 24, 25, that is what the rate is going to help you grow faster. And from that perspective, those are companies that we would be more comfortable to have. And as I mentioned, they were focusing also on the income. Sorry, pardon me, this is wrong. This is where the circle should be. Now, the margins have also been at a steady clip. But what happened is, one is that the consensus estimates on the potential change going forward had started to change over here. So if you see, and when we exited was in September. Why? Not because the next quarter you'll see the results were good, but the point was that going forward, the expectation was that it might not sustain. So what we also incorporate in our approach is the rate also increasing? And from that perspective, where there is a challenge, we also bring it into our execution, that then I'm probably going to look at something better. So as I've mentioned over here, that the focus was on growth on margins, but the estimates on potential challenges to the rate of growth was the trigger for my exit. And I think one of the questions that was also there in the list that was sent was that, don't you think so? The returns are superior. So don't you think that this sort of instrument is risky? Now, the answer over here is there is a inherent risk when you invest into equities. But then if you do this, as I mentioned, that if you are looking also at the rate of growth, the chances of you moving out at a higher level before the potential correction starts is higher. So in a way, this helps at one level to get better returns. And on the second level, it also helps you to sort of save the investor from the drawdowns. Now, that is how we sort of, so you see those returns being higher. It's also because this is one level of analysis that is being brought into this portfolio, which is why you see that we've done fairly well during this period. Again, the intention is to explain the concept, why it becomes better. It's not really, and again, no buy and sell recommendations on Polymedicure, because things have started to recover, but then that's not the intention here. The intention here is to just to explain why and how that investment cycle plays out and how we try to add value to the client. Now, a second example, which is relatively more recent, is Naveen Fluorine. Now, again, I would like to link it to the fact that what we saw in the first few slides, chemicals were also a big play within those sectors. Now, within that, and I also mentioned that there was a time where chemical sector was absolutely in the dumps, especially in post 2022, purely because after the Russia-Ukraine war, there was massive stocking that happened in Europe. Now, after that, when the down cycle came, now if you see over here, very clearly the reasons for investing into the company was one, capacity expansion during that time, which was very focused on certain chemicals which have a pretty steady state requirement, right? So capacity expansion during that phase. The second part, that looking and focusing on CDMO. And basically, typically, you may be aware that CDMO plays tend to be higher margin products. right? So you can see the third part was about margin expansion. And how do you do that? By shifting the product mix. So the chemical sector was starting to rebound. The capacity expansion in the right sort of company in terms of focus areas was being done. The margins would start improving because the product mix is essentially moving towards higher margin, products. And lastly, this would be probably of interest. A lot of people speak about, so one of these questions that tend to come is, look, why aren't you focusing on data centers, for example? So data centers, again, the way to look at it is you want to deep dive into those companies which are servicing data centers. And within that, you want to see which is a safer play. So, for example, for Navin Fluorine, there is a global company named Chemours, right? And they are basically, you might be aware that data centers require a lot of cooling, right? And typically, historically, you would think of water, but there's a problem in having that sort of water. So typically, if you're faced with such a problem, what do? You try to generate a chemical or molecule which is going to allow you to do the same cooling more efficiently. Now, within that, Chemours, which is a global giant, has actually been able to get such a product off the line for them. Now, typically, as I mentioned, when you look at a CDMO sort of a play, what you're looking for or these companies are looking for is dependability and cheap production. And that's where a company like Navin Fluorine, given their history in specialty chemicals, specifically fluorine, there are not many chemical companies which are very strong in handling fluorine, which is extremely reactive. So from that perspective, that is what also, and given fact, if you see R32, this is a refrigerant, which is environmental friendly. So these aspects are what helped Naveen get a deal with Chemours. In fact, one of the capacities that was set up by Naveen Fluorine was with Chemours investing into that plant. So when the sector is doing very bad, and at that point in time, you see somebody investing into a particular plant of their vendor, that's what gives you comfort that probably those orders would actually come through. Now, this right now would not seem pertinent, but when things are not good, these are things that also give you comfort. And from that perspective, that these are the aspects that made us choose Naveen as an investment. And from that perspective, now if I look at the next step, like I specifically mentioned earlier as well, that we are also incorporating the analysts' views from that perspective. So again, April 24, when things weren't very great, just the turnaround had started in terms of growth, right? Margins had also started growing. So over here, you can very clearly see you're investing into a turnaround, but fundamentally, you know why this company is going to do way better than the rest, and which is what gives you conviction even when things are. So if you see, you invest into April, the results of June will obviously come in July and August, right? So you don't have that, but that's where the research comes in and understanding that, look, why it is important, right? And then what you see is, so for us, the current view in terms of Naveen, in terms of the analyst community, has been very clear. Again, if you can see, this was more of a, as I mentioned, the rate of change of growth. Now, if there's a company which is continuously growing, typically those companies would invite more attraction, and typically the valuations would increase. Why? Because it's continuously growing. Even the rate of growth is growing. Now, at this point in time, around this phase in March, we exited, and the view over here essentially became contrarian. Why? Because the peak in terms of the rate of growth had come. So when that became the analyst view, and the understanding for this company became that, look, probably we are at the end of the rate of growth. So is 33% bad? Absolutely not. It's an extremely good growth rate when I'm saying that the broader markets does 13 to 15%. But now if you look at it from the perspective that, is the rate of growth going to reduce, and could it possibly hit the client on the price front? The potentiality is high. So at this point in time, we started looking for another growth story, and that's what we invested into. It's a chemical business story itself. But then what you understand is, so are we bullish on chemicals? Yes, it is a constructive space. But within that, And is this a company which could not be held, since 33% is not bad? It's not bad, but then the rate is changing. So from that perspective, we've got into something else where a cycle similar to this has just started out. So that's really the way we look at investing, and there are multiple facets to it. So there's a fundamental side, but this sort of differentiation helps us to also try to move out when the going is good, especially given the sort of situation that we are facing in the market where there's a lot of volatility. So this sort of gives a higher level of safety, to the portfolio. And yeah, that's something that I wanted to share. So again, if I was to summarize, it's about where you want to invest and why you think those sectors will do well, the government push, the regulatory push that is there. And within that, then you start deep diving into why that particular company within the sector will do well. And then you find specific triggers for this to happen. And eventually, if those triggers keep playing out, you would want to stay in the company. And if the triggers are in terms of rate of change in growth, if they are going to trim or going to shift, there could be, if you've got better opportunities, that's probably a good time to look at something better. And that's the way we sort of approach this investment advisory. And yeah, that's about it from my side. Ankushji, over to you.
Sure. Thanks, Kaustubh. Thank you so much. So, just for all the audience, I would like to also highlight that from the day inception when this study started, that was 30th April 2024, uh, till 30th April with this volatile time basically. This strategy has given a CAGR of almost 14% vis-a-vis the market. Nifty 50 has just delivered 3.5% positive returns. So we have almost created a alpha of 10% vis-a-vis the benchmark basically. So this was a brief in terms of what is how we are performing. We have already shared few literatures with Cube team. If you want, we're open for discussion also. Varun, anything you want to add, or you have any questions specifically?
So a few questions were asked. I think a lot of them Kostav has covered.
Yeah.
One of the questions that a lot of people have asked is not with regards to the fundamentals or philosophy, but with the way of investing. So, like the current market, should we be investing at one time or gradually? Will the market bottom? Which is kind of what everyone asks often. That is this the right time to get into the market? And if so, how? Is there any SIP that I should look at? If the product offers any such facilities, those parts, I think, if we can briefly touch on.
We'll just cover base this the same part. For all the participants, this is basically investment advisory offering. So it is very transparent model. I'll just give you the modus operandi where customers' money lies with the customer's demat account itself. And the best part is it's a fixed fees model basically. We charge a consultation fees for 3 years basically. So earlier we used to also have a profit sharing, but from SEBI's end, from 2021 there is no profit sharing basically. It's a fixed fees model. So the best part is in this offering you can have a blend of both basically. So we have a SIP route also where customer need to tell at the time of agreement that what amount he or she is looking basically. We can have a SIP mode in the same. Plus adding to that, since it's a fixed fees model, at any point of time, in fact, we also recommend customer also need that. Suppose I got a lump sum inflow, and if you want to infuse, he can do. We are invited to share the recommendation for next 3 years. There won't be additional costs in the same. So customer can have a monthly SIP model plus a lump sum at any point of time for next 36 months. And the best part is, Varun, as I said, this model itself gives flexibility for investor if they think that market came down, for example, in terms of valuation or overall, for example. So at any point of time, they can ask for a further recommendation also. So it gives both the flexibility, SIP plus lump sum. Yes. When you're on mute, basically.
Another question that has been asked is that currently we see a lot of retail participations. Earlier, it used to be more localized or people with high net worth only inflowing money. So with the retail participation going up, will we see a less of the extremes like high bull runs, very poor bear runs, or drawdowns, market moving up? Will that going forward? This is in general about the market. Will we see something like that? And another question with regards to different asset classes is that how do you see other asset classes, say real estate, debt, gold, in the near future? How do you think those things will play out?
So, Kaustubh,
So, yeah, sure. So at the first level, if you look at retail participation, so there are two parts to it. You see, a lot of this money is also going through mutual funds. So if you look at the scheme, it's like money flows into mutual funds or domestic institutions, and they are now investing for their investors. So in a sense, I would like to think that it's more institutional now. It's more of institution versus institution. It's just that earlier FIs had the fact that retail participation was not so strong, even through mutual funds, that even when there was a heavy selling that came through FIs, you didn't have a counter to balance it. So from that perspective, is this something that would continue? I think it would, purely because now a lot of that money is also flowing through mutual funds. So there is a degree of institutional level understanding that is there. So from that perspective, I would hope that panic would be comparatively lesser, and hence those corrections would typically be shallower from that perspective. But I think when you look at the recoveries or the upside, I think there is a very clear requirement for both the engines to fire. So obviously, having retail participation and through the domestic plays or institutions does help on the lower side. But I think for the firing to happen on the upper side, in terms of the upside in the market, I think we would require certain participation from the FIs. Definitely not as much as what we would require earlier, but I think that would be required going forward. One of the reasons why I'm saying this is that I know that the retail participation even today in India is low, if you compare to other countries. But the fact is that whenever a new thing starts, and there has been that phase where mutual funds were also heavily sort of marketed, a lot of these early adopters, I think, have already gotten in over the last 5 years. So from that perspective, the alpha or the increase in terms of how much money would flow in incrementally might start slowing down. So if you look at the last 3-4 years, those inflows have doubled. Now, do I expect that sort of doubling to happen going forward? Probably not. The rate, again, we spoke of rate of change or rate of growth. That change, I think, will start coming in. So that is something that we cannot expect for the next 5 years, what we saw in the 2020-24 half, end of the year frame. That's the way I would put it. One of the concerns, because we are talking of retail, is, of course, I'm just pointing it out, because if a theme works well, especially through retail participation, you've got to understand that it's about perceptions. So if I was to look at the flip side or the negative side, I would keep a very keen eye on the fact that how retail is looking at in terms of the inflows and outflows. So today, the last 5 years have seen the positive of it. That is something that I would definitely keep an eye on. I mean, the idea is just to tell you that whenever you look at any play that's happening, you obviously want to look at the upside in terms of the benefits, but you should also know the downside. So the risk associated. So that would be one thing that I would keep an eye on. But to give kudos to retail investors, that we are more than 18 months into a correction phase, and what you've seen is that retail participation has actually stood steady. So I think the level of maturity that has been showcased has been quite good, because as I mentioned right through the slides, what you'll see is that there are those opportunities that are there. The economy is growing, so there is that scope for earnings growth. So it's also about being able to manage these downturns with a more calm mind, as long as you know why you're invested into whichever company you're investing. I think that's the way to look at it. And just to speak a bit about, the previous question, you spoke about, is it a good time or a bad time, or how we should look at it. Now, historically, again, this is data. So it is not necessary that it will happen exactly the same way. But historically, what you've seen is that these sort of corrective phases tend to last anywhere between 15 to 22 months. That sort of thing happens. Does it ever extend? It does. But it happens once in a while. Typically, what happens is this, about 15 to 22 months sort of thing. Now, we are, I think, in the 19th month, if I'm not wrong, 18 to 19 months. Now, given that, what I would say is that probably we are at the end of that phase. So that's the way I would look at it. But there is always the superimposition of fundamentals. And if you see, I spoke about one slide where, there is focus, a few sectors are the focus areas, but for example, textiles had a problem. So you need to also go one level lower because the world isn't the same as it was in that 2020-25 phase where there was general globalization, things expanding. Here we are getting more protectionist. So you've got to be very, very specific in terms of where you look at. So are there opportunities there? Yes. Should you invest? Yes. Is there volatility that will be there in the market? Yes. And hence, from that perspective, SIP sort of mode allows you to go through those cycles better. So will you get hit sometime? Obviously. I mean, if you buy, for example, if you bought in Jan and then you saw March levels, obviously you're going to feel that, look, I could have bought cheaper. But that is going to be the nature of the market. The problem is it might not be as easy to time the market looking at how things are playing out. So from that perspective, I would advise an SIP mode. That's the way I'd look at it. Just one last part. I think one of the questions was also about, what do you think will happen in the next year or so? Given what's happening right now, and this is also trying to answer your question about why SIPs, that basically what you're seeing is that right now the results have been actually pretty good across the market in terms of earnings growth. Now, the problem is because things have started to change end February, and if we were running, factories or manufacturing plants or any sort of setup, you would typically have inventories of around 30 days. So what's the problem is you've not seen any of that impact in the results. So what we do expect is that in quarter one, that is for the performance from April 2026 to September 2026, margins could be under pressure. And so from that perspective, this will also be a phase where some of this pressure might get reflected on your stock market. Now, if that gets reflected, that's where you would like to, take those buys. If you recall, I started off by saying that corrective phases tend to last about 18 to 22 months. So whenever the corrective phase ends, it's typically when the night is the darkest. So that's really the way to look at it. So I'm telling you that this is going to happen. The next 6 months would ideally be the phase where you are going to see problems. But then that's the reason why you're going to get things cheaper, right? If everything is good, why would you get it cheaper? So that's the way you should look at it. And again, that's why I'm saying it should be more fundamental in nature. You should know exactly why you think that company will do well. And that should hold you in good state. Yeah.
I think there's another question on other asset classes, or say global equity, real estate, gold, debt. How do you
Sorry,
see
I
that?
missed that out. Yeah.
Huh.
So basically, asset classes is so the first level understanding that I would recommend is that one needs to understand what your asset class in terms of how you've actually diversified. So should we diversify? Again, I'm going first principles. So typically macro to micro. Should we diversify? Yes, definitely you should diversify. That's one part of it. The second part, when you speak about any of these asset classes, there are certain points that you've got to understand. So, for example, you look at gold and you'll see from 2019 onwards, there was this very clear shift, with all these central banks starting to buy gold, right? So that should have ideally been the trigger that, look, something is going on. And I think in 2022, after Russia, they had money in dollars and that got stopped in the sense that your own money you cannot access. That obviously, set the cat among pigeons, and that's why gold buying started at a much frantic space because, if a dollar can't be spent because a country suddenly decides that no, I won't give you access, things need to change. So again, that also tells you why diversification is required. But having said that, now we are almost into the sixth year of that purchase cycle. Now, even for RBI, if I'm not wrong, we are at around 23%, of their in terms of the money that they have, bonds, etc. They also have gold, right? Now that's a significant amount, right? But then what that also tells is that we've probably reached a level which is quite high. So from that perspective, can I expect returns from that perspective, what I might have seen over the last year? Probably not. But then should I have a hedge? Yes, you should. Why? Because then when things go bad, you can also flip back, right? So from a hedge perspective, you should have it. But then that's the way I would look at it. I would not look at it as an investment class. I would look at it as a hedge. And if you get that benefit, great for you. But it's safety that you're looking at. Because if you look at gold, I know I'm speaking a bit more about gold purely because people have seen a magnificent rally in commodities, some of these commodities. So it's just that when you look at gold, it's more about a fear because you don't really use it. Silver, you use it in industries. Gold is something that you store. So it doesn't generate things for you, frankly. So from that perspective, you should understand why am I calling it a hedge? You don't generate economic value out of it, right? So that's the reason why it's a hedge. But should you have it? Definitely. Now, if you're talking of global, equities, now, if you look at 2024, the valuations were pretty high for India, and there were reasons for it. The growth was, pretty good, 20+% sort of earnings growth over a period of maybe almost 8 quarters. And it was actually higher, and then it started coming down. So there were n number of reasons why the market was being valued that way. I'm talking that we look for 18 to 20% growth in our companies, and the whole market was generating that return during that time. So there was a reason why those valuations were accorded to the Indian market. Are we seeing those sort of earnings growth right now? No. So obviously now the focus has shifted, if you look at the last 2 years, to other emerging markets like Taiwan, for example, especially if you look at the AI play, chips, etc. So that is something that has helped. China also, after a period of, their valuations were correcting. Obviously, the economy itself was in trouble. But given that their valuations became cheap, so some of these emerging economies did pretty well over the last 2, 3 years. But now, having said that, again, if you correlate it with what happened in our market over the last 18 odd months, we have sort of gone nowhere, whereas the other markets have actually run up. So valuation wise, we are probably now better, comparatively vis-a-vis where we were about 2 years back. So from that perspective, as juicy as it might have been about 2 years back in terms of attractiveness to invest into these markets, is the thesis still valid? Yes, but is it as attractive as it was before? No. So should we invest? Yes, but you've got to understand that this is how it's playing out. So again, there you have to be very specific about what you're investing into. I don't think you're going to see the general overall market like it has over the last 2 years run up. So very specific you'll have to be. But the last part that I will say is why equities, real estate also I think was a question, commodities such as gold, etc., asset classes. In general, what you'll see is that whenever inflation happens, so where does this come from? There's a problem with fuel supplies. So supplies are a problem. You're going to see prices go up. Now, what is that going to do? It's going to increase the prices of everything, right? Because transportation, everything goes up. So from that perspective, you are going to see inflation. So when inflation starts going up, it is assets that also start going up to, sort of catch up to whatever inflationary pressures are happening. So asset inflation will happen. Hence, you should understand that, yes, will asset prices go up? Yes. But the reason is this. So equities will also go up. Real estate will also go up. But again, there are vagaries to it, right? So for example, if you're in a city which is more densely populated with IT sector people, and you know what's been going on within the IT sector, AI is causing certain challenges. So I would then again say that it has to be very specific to where you're trying to invest. So that's the way to look at it. Everything will have inflation factored in, so you will see price rises, but you'll have to be very specific in terms of why you're getting into that particular area and why it should grow. So yeah, That's it from me. But
Thank you. One last question is with regards to robo-advisory and AI trade that taking up a lot of space in this sector of investment advisory. I'll give my input for if you
please.
allow me. It
Yeah,
is
sure.
not from the technical point of view, but more from a behavioral point of view. Is that there is a concept called salient uh, bias, which means that you start to look at things which are more visible than things that are, you start investing in things that are more visible than things that are more valued. So to whoever this question who has raised, if you see any of these robo advisory apps, what you'll see is top gainers, uh, high most volume, whichever is getting the most volume. Those things kind of take over trending stocks, most bought, hot picks. These are the things that kind of take over. Earlier, so I have been in this industry for almost 16 years now. When we started off, we started with looking at balance sheet, annual reports. Now those things have started changing to algorithms, and algorithms now decide what you see. So the more a stock trends, the more it get kind of pushed into your feed, and the more visible it becomes, the more investors assume that it must be good or important. This is something that is changing in retail investing, not necessarily I'm saying that every top gainer or most bought is bad, but one of the problems robo advisory is bringing into the picture is that visibility is replacing analysis. So be a little bit circumspect when you are investing, that whether this is a stock or any product per se that you need or is valued correctly or is just visible. If Kostav, you can kind of add the technical part into it.
No, so that I think you've covered at a psychological level, and frankly, that's how it works. But the one question that if you could just repeat specifically the query, because one part was the AI part, but
So with
yeah,
AI
yeah.
trade, robo
Mm.
advisory, these things kind of taking over, how does it
Mm.
impact the future of investment advisory in India?
Okay, okay. Yeah. So basically, yeah, you're right. What you've said. Essentially, what you've got to understand is AI is not intelligent. What you have is there is data. That data is something that they refer to and then they give an output. So it's very, very pertinent as to what you are giving to AI. So it's like, the food we eat, depending on what we eat, the situation in terms of how we feel is going to happen, right? So essentially, that's one part which becomes important as far as AI. Is it doable? Yes. The problem is, are there many people who are competent to do all these things? So, for example, one is the data that you are feeding, right? The second is the kind of prompt that you're giving, in the sense that what is the question you're asking. So, if you can imagine a super intelligent person in front of you and he has all the answers, for example, because that's the assumption that we have about AI, the thing is that you need to know exactly what to ask. And I mean, it might seem a very simple thing, but frankly, it's much more nuanced because for every company, the sector, the question might be very pertinent. You have to have very pertinent questions to ask. And from that perspective, AI prompters itself is a role in terms of a job role. Why? Because there's skills required to ask the right sort of things. Now, can it catch up over a period of time? Probably yes. Given the rate at which AI is increasing, the spread in terms of the scope, yes, it's possible. But are we there at this point in time? I don't think so. We could probably get there, definitely, but it's going to take some time because all of this needs to play out. And from that perspective, at this point in time, yes, there are benefits. Even investment companies are trying to leverage AI because it's easy. If I know the right sort of questions to ask, I could cover more companies. So it does have, in terms of efficiency, it helps. But eventually, the decision making has to be about people. And as Barun mentioned, that just because these are linked to data that is being generated. So, for example, if all of us decide that a company is good or we feel quite optimistic about it, AI is going to see that data in real time and assume that because we have all decided to be excited about a company, we are right about that choice, and then AI will also start recommending. So it is about data in, so it could be garbage in, garbage out as well, which is the risk. So yeah, that's it from my side. But
I think we have covered all the questions. If there are any more questions, people can kind of write on the chat. We had opened it. I don't see any other questions at this point of time. So I think we can kind of conclude the session. Thank you very much, Koustubh. Thank you very much, Ankush, for your time. Thank you for
Sure.
everyone who has joined.
Thank
yeah,
you
I'd
so
like
much.
to
If
thank
you have any
everyone who
queries,
joined.
please
Yes.
feel to reach out to us. We are open for any further queries also. Okay.
Sure.
Thank you, participants. Thank you, Varun.
Thank you.
Great.
Thank
Bye.
you.
Thanks.
Pleasure.
Bye.